The Irish food group Greencore, which is listed here in the main market in London, has told investors that it expects full year numbers to be at the lower end of forecasts as industrial action and a slow recovery from inflationary pressures hits demand and volumes. If you look at the share price chart, you can see quite clearly the drop that we've got here on the far right hand side with that red candle. We're off the lows at the moment, but nonetheless still down some 4.2% on the session today, down at 73.1. If we look back at this chart, you can see the record highs we saw all the way back in June 2007, before the great financial crisis. But one of the more recent lows that we've seen is the COVID lows. If we draw that line from there, back in March 2020, you can see clearly recently we've been trading below that. So it is below the COVID lows that we've got. And Greencore says that while inflation has been easing in some raw materials and packaging, labour and energy costs continue to hit earnings. This is a company that produces takeaway foods such as sandwiches and convenience foods for all the major retailers across the UK. So it's got a really big footprint. As consumers, we don't know too much about it because we just eat the products that are sold by some of those big retailers that we attribute to in making these products. But in fact, it comes from companies like Greencore, which is suffering so much. So the outlook looking very poor, not just for Greencore. We've seen other evidence today as well from the likes of Britvic and Fevertree as well, saying input costs are inflationary. And unless they can continue to absorb those inflationary input costs, they have to then hand them on to the end consumer, which in part is what they're doing already. But there's going to come a point where consumers won't pay the extra money.